Good morning. It's 10 a.m. and I'll call this meeting to order. Winter, will you please take roll?
Chair Brooks,
Here.
Vice Chair Arascata, Regent Fernandez, Regent Goodman, Regent McGrath.
Here.
You do not have a quorum right now. Angela, is Vice Chair Arascata in Reno?
You know,
No, not yet.
Okay.
I appreciate that, Winter. Regent Brooks for the record, Chair Brooks of the committee. We'll wait 5 minutes and restart the meeting. Thank you. Good morning. We're gonna try this again, and we'll go right into a roll call. Will you please help us out with roll call, Winter? Thank you.
Chair Brooks,
Here.
Vice Chair Arascata, Regent Fernandez,
That's it.
Regent Goodman, Regent McGrath.
Here.
You do have a quorum. Advisory members, Mr. Garcia, Mr. Densler.
I'm here. Present.
Oh, thank you, Mr. Garcia, and I heard you, Mr. Densler. Thank you, Mr. Chair.
Thank you. I appreciate that. We'll now move to the pledge, and I'll ask Regent McGrath to lead us. Okay, thank you. We'll now move to agenda item number 1, which is public comment. For those who'd like to call in and offer public comment, please dial 669-444-9171 and enter meeting ID 933-5568-7402 and passcode 555555. Is there any public comment at GBC?
There is none at this time.
Thank you. Is there any public comment at the system office in Reno?
None at this time.
Thank you. I don't see any public comment here in Las Vegas, so we will move right into agenda item number 2. Basically, just a consideration.
Mr. Chair, sorry to interrupt. You have to ask for public comment on the phone.
Thank you. I appreciate that, Winter. I have to dust off a few of the cobwebs, right, for the chair spot. Is there any public comment through SES?
There's no public comment at this time.
Thank you. Appreciate that. Now we'll move into agenda item number 2 for our minutes. And this is really just the approval of minutes, and I'd ask for a motion to approve.
Move to approve.
So motion by Regent McGrath, and it sounded like it was seconded by Regent Fernandez. We'll just do a quick voice vote for this. All those in favor, please signify by saying aye or yes.
Aye.
Aye.
Those who oppose, please signify by saying no or nay. The motion passes. Thank you. We'll now move on to agenda item number 3, the chair report. The other thing I have to report is that I certainly appreciate those who are here being here, and I'd like to welcome new regents who are new to the committee, and I look forward to working with everyone as we move forward throughout this next year. One of the things that I do want to bring up just in terms of our agenda items for today is please note that we're going to move agenda items 5 and 7. So we'll hear agenda item number 5 last, which is actually the an action item for us today. That way we can hear all of the information-only items regarding the endowment and operational pool prior to moving to a possible vote. What I'd like to do now is move to agenda item number 4. And I would like to call upon our Chief Financial Officer, Chris Fatone, to provide us with an overview regarding the investment committee.
Good morning, Chair Brooks and members of the committee. I didn't want to pass up the opportunity to stand at the podium today, so I'll have you deliver from here. We did have on your agenda this morning with a couple of new committee members and new board members wanted to just give a high-level overview orientation for the investment committee to go over some roles, responsibilities, and a high-level overview of the related policies for the committee. One of the things that I did want to bring up just in terms of our agenda items for today is please note that we're going to move agenda items 5 and 7. So we'll hear agenda item number 5 last, which is actually the an action item for us today. And so I will keep this real high level. We did provide you with some materials that included the actual excerpts from the handbook with the policies, and some other resources, some articles and things from Cambridge. So I'm not going to go through all those materials, but I'll go through the presentation and then happy to take any questions. And if you have questions at any time, always feel free to reach out to me on those. So I wanted to start with just a quick high-level view of what your NSHE Finance Department Banking and Investment Team represents in an org chart, with myself, Assistant CFO Rhett Vertrees, and then his staff, banking investment staff, Brenda Ford, Janice Baldwin. That is your NSHE team, and then you'll see the box on the side there, the outsourced Chief Investment Officer. And I will talk more about that and their relationship and importance in the org chart that manages these assets for you. This slide, it's slide 3. This is an excerpt from the bylaws of the board. This is Article 6, standing committees. This is the investment committee duties summarized. It's not word for word from the bylaws, but this is a summary. These are the duties of the investment committee. So it's overview, oversight of the investment policies, implementing recommendations from your advisors or your staff on the endowment and operating pools, and reviewing and evaluating the performance of the managers of the funds. And then again, high level, how this translates to responsibilities of the members. As you can tell from your agenda materials and the recurring items on the agenda, it's high level overview of the funds and performance, and you receive reports in that regard each meeting. A quick mention, I think we mentioned the fiduciary duties under UPMIFA, or the Uniform Prudent Management of Institutional Funds Act. That is an act that was updated, I think it was in 2007. It's been adopted by 49 states. One state has its own laws, but essentially all states have adopted the guidance of MIFA into state law, and Nevada is one. The one that doesn't has very similar requirements in its own law, and that's their reason for not adopting it. But what I would like for the board, for the committee to know is and understand is your policies have incorporated the guidance of UPMIFA, and so following your policies keeps us compliant with those requirements. Those requirements tend to focus on investment policies, reporting, spending distribution policies, and diversification. And again, all the guidance that's within UPMIFA is actually incorporated in your policies. Do a quick overview, and I think I always realize when I get the presentations that some of my slides I would order in a different order, and so we'll go through them, and I may jump back and forth a little bit. But the system has two separate funds, and we refer to them as the operating pool and the endowment pool. And the operating pool is the campus daily operating funds. These are the funds that this is where campuses' fee collections are deposited, all their sales and service activities, all their self-supporting activity, all the programs they're managing. It is where state funds are initially deposited. State funds balance to zero throughout the course of the year, so at the end of the year there's no balance forward in state funds, but all their self-supporting activities are held in the operating pool. The operating pool has a long-term objective of maintaining a relatively stable stream of revenue that equals or exceeds the rate of inflation on a rolling 10-year basis. The funds distributed in three components, the long-term pool being the portion not needed in the medium-term or short-term pool. The short-term pool is the funds available needed for daily operation, and the medium-term is contingency. And so that's kind of how the levels of funds required in each of the categories are determined. Monthly distributions occur according to your policy. Again, one of the policies in the handbook. That distribution policy currently distributes to the campuses 2.75% on an annualized basis, distributes it monthly on their proportional share of these assets. These assets are pooled at the system level. It's all deposits of the system that are pooled into the operating fund. The endowment fund is the system-held endowment. So, you know, your institutional foundations, the UNLV Foundation, UNR Foundation, the other institutions' foundations also have their own funds that are managed by those foundations. The system endowment is managed in the system office, and that's the portion that you receive the reports on and that is managed by Cambridge. This is the area where we have the outsourced chief information officer relationship with Cambridge. So Cambridge serves as your outsourced chief information officer with actual discretionary authority over the endowment fund in alignment with your policies. So this is where they will take action as your CIO. And that's why when we go through your report, they do not serve in that capacity on the operating fund. They are our advisor and manager on the operating fund, but they're not in the role of chief investment officer, outsourced chief investment officer on the operating funds. And so for that, that's why you see action items in your operating fund reports where you're authorizing the rebalancing versus in the endowment fund where those activities are actually under their authority in the OCIO role. Here also you have a long-term objective of stable revenue streams for spendable revenue that increases at least as fast as inflation. And here you have a spending distribution. It's a quarterly spending distribution that's also under your policy. The current distribution rate is 4.5%, set as a maximum. The campuses actually have the ability to select less than that, but it's a maximum of 4.5% with an allowance for the campuses also to have a management fee as a component of that. I don't have, I apologize, I don't have in my notes the last time that rate was adjusted, but it's been stable for at least the past 8 years or so. And I've already talked about these. Again, I think just for context, the operating pool generally in the neighborhood of $800 million that's being managed in that pool. Endowment pool is about $320 million. Again, some key investment policies and guidelines, and again, your policies go into much more detail in these areas, and I don't want to go through the full policy for you, but each policy addresses the asset allocation targets and risk tolerance, and of course the spending distributions. And part of your role in the committee, reviewing and monitoring performance and reporting, and that's a good portion, if not the majority of most of your agendas each meeting. Wanted to highlight a couple of items that to anticipate as the committee. The OCIO relationship began in 2016. And we are approaching the point we're planning a solicitation that was awarded at that time as a result of a solicitation, and we are preparing to initiate a solicitation being at the end of the terms of that initial award to revisit that for you again. So that'll be coming up for you. Rhett and I are discussing the timing of that, trying to aim around your September meeting, and I'll get you some updates in the interim on that. And then again, the committee meetings, as you know, they're semi-annual, so we meet in March and September of each calendar year. And I'll stop there and see if you have any questions.
Thank you. Are there any regents with questions? I don't think we have any.
Chair Brooks.
Oh, there we go.
Chair Brooks,
Yes.
can you hear me?
Yeah.
Regent Goycochea at GBC.
Go ahead, Regent Goycochea.
Thank you, Chair Brooks. I'm just a little bit unclear. The operating pool, now you said that is at 2.75%. Now, is that, then how do you figure that down? Each institution, how big a percentage then of that pool would they get?
Regent
Or
Kokachi.
do they apply to the investment committee to get it, or how do you disseminate the operating pool?
Thanks for the question, Chris Vitone, for the record. The 2.75% is the rate that is calculated against the entire pool. Each campus, the system office tracks the proportional share of the operating pool that each campus represents. So it's the campus's cash that is invested in the pool, and that earning distribution is distributed on a proportional basis. So each campus gets its proportional share of the monthly distribution, and those monthly distributions are automatic. So each month we distribute 1/12 of the 2.75% annualized. And then the policy also has provisions where if the market value exceeds, is greater than 8% higher than the cost basis of the investments, that excess is also distributed proportionally to the campuses on a monthly basis. If the market value falls to less than 3% more than the cost, so if it declines where the reserve, that excess of cost over market value over cost falls below 3% for 3 consecutive months, those monthly distributions are also suspended. So the policy, the distribution policy has some automation to it that allows the campuses more predictability on their monthly distributions and visibility or transparency to the monthly distributions. But it is always proportional to the campus's share of the total operating pool.
And that's on a per student basis. So your enrollment.
It's based on the campus's actual proportional share of the cash balance. So it's not based on any institutional metric. It's based on the actual cash in the bank, if you will. This represents their bank balance in their operating funds, and the investment distribution is proportional based on that cash balance.
All right. And then if I may, Chair Brooks, Regent Goycochea for the record, then as we see in this little shift in the stock market, do we anticipate over the next 60, 90 days, there's been, I looked at the percentages too, is there a possibility that will trigger and if it continues, there might not be a distribution there? And if there is, how do we pick that up?
Chris Vitone again. Thank you, Regent Kokachi. We do monitor that, and each month, at the end of each month, we are evaluating the total pool value compared to the tracked cost to determine whether or not a distribution can be made. Do we anticipate having to suspend distributions? We certainly are monitoring it closely, and there have been instances where that policy has been triggered. It has not happened yet. I don't know if I have a more recent month-end value. We do, in the operating pool report, we actually have a schedule in the back there for you that shows the monthly ending balance of the reserve compared to the invested principal to see where it lands. We've actually had excess distributions going in through the end of the fall. And we've been able to maintain distributions so far in calendar year 25. They have not hit a point where they've had to be suspended yet.
Thank you, Chair Brooks, and I apologize. You gave me just enough information to totally confuse me, so thank you.
All right. No problem, Regent Goycochea. Are there any other questions for our CFO? I don't think we have any other questions. Thank you. What I'd like to do is, as we move into agenda item number 6, is welcome the Cambridge associates that we have here in the system office here in Las Vegas. Is EJ Oboiche,
EJO Beige for the record, Cambridge Associates.
Thank you. And then coming in through Zoom is Wendy Walker. And I'm not sure which one of you would like to present on agenda item number 6, the endowment pool.
EJO Beige for the record, again, Cambridge Associates. I'll be presenting.
Thank you.
So, again, Article 6, I'm happy to start on slide 9. Here's the clicker here. Thank you. Here, what we're showing, again, we're looking at, this is calendar year 2024 performance. And I'd start on the, with the current market value at the end of the calendar year, just over 343 million in market value, with the preliminary returns for the calendar year at 9.9%. You'll see in the middle column there for calendar year to date. That is about 370 basis points below the policy benchmark for the calendar year. But when we look longer term, we see over the trailing 5 years and the longer since the beginning of the relationship and since inception, we see trailing 5 years, 60 basis points above the trailing benchmark, the policy benchmark, excuse me, at 8.1%. And the, again, annualized since the beginning of our track record, the beginning of April in 2017, we see the performance at 7.9%, 20 basis points above the policy benchmark. I want to go to the next slide to just create a bit more context. When we look at performance over a rolling period, you get a better sense of how performance has transpired. We're coming off of the last few years. Since 2022, we saw a market sell-off, which was primarily, we saw public equity, both equities and fixed income fall precipitously as we saw some tightening in the monetary policy that drove interest rates higher. And since then, we've seen a rebound in returns. What we've seen is that the total endowment has recovered, not as quickly as the policy benchmark, but still adding value over this period. And we see that at the bottom half of this page, we see the value added versus the benchmark. Since the 2022 sell-off, we see the value add come in a bit, but still seeing positive value add over this rolling 5-year period. I'll take a step back when I look at performance again. So let me just jump back a page here. When we look at performance, this is through the end for calendar year 2024. Just to give the update for the current year, we have performance through the end of January. We see the portfolio up 2% for the month of January. We have preliminary returns for February down 40 basis points in February and down another 1% in March. So just giving some context for the volatility that we've seen thus far in 2025. So jumping to page 11 here, when this is looking at the OCIO track record, again, since April 2017. But we note that we have private investments lagged as of September 30, 2024. And that's really just to include all of the final performance that we have because Q4 of 2024 does not have final private investment performance recorded just yet. So what we observe here is that the annual compound return for the total endowment is 30 basis points ahead of the policy benchmark, and that's done with a bit less volatility, or as shown by the standard deviation here in the middle column on the table on the right. So we see just 12% volatility or standard deviation for the total endowment versus the 13.4% of the policy benchmark. And that's how we get a higher Sharpe ratio or better risk-adjusted returns. On the far right column, we see 0.59 for the total endowment versus the 0.51 of the policy benchmark. So stronger risk-adjusted returns over the period of our track record. When we decompose performance a bit more, looking, again, this is actually just looking at the calendar year 2024, but again, this does not have private investments for Q4 because those results are still being tabulated. So looking for 2024, what we see this the underperformance versus the benchmark, how we get there can largely be attributed to underperformance from private equity and venture capital. And we break out both the managed private equity or private growth versus the legacy private growth. But more to say on private investments in the following slides, as we'll have a bit more context in terms of what we how we view that performance over the long term. But in this short-term period where private investments are benchmarked to public market indices, we do see this dislocation. Despite some of the positive attribution or contribution from our growth marketable alternatives, which are growth-oriented hedge funds. Looking at page 13, when we look at the full OCIO track record, but again, lagging performance through September 2024 to include our full track record and the most recent tabulated private investments, we actually see that the private investment, managed private growth, rather, did contribute to the portfolio to the tune of 55 basis points here. So more to say there in the following slides, but we do see private investments, specifically private equity and venture capital, as a significant contributor to performance over the long run. When we look at slide 14, this helps bring into context some of the volatility that we've seen in the markets to date. Some of since the 2022 sell-off that I recently mentioned, this was a year where public markets, as shown by the dark blue line for the MSCI All Country World Index, or a public equivalent benchmark, that industry was down nearly 20% in that year for 2022, while private investments were down much less than that, nearly half of that. These dislocations where you have a year like 2022 followed by extreme up years in 2023 and 2024 where public markets were up over 20%, you have extreme dislocations. We still find that private investments add value over the long run, and that's shown by the black solid line here, which accounts for the rolling 5-year period of outperformance of private investments. So what we haven't seen, like this period now in the far right circle in red, we haven't seen back-to-back years of extreme up performance followed by an extreme down year like in 2022. So looking back to the financial crisis in 07, 08, there was only really 1 year where you saw the up year more than 20%, and even back to the tech wreck in early 2000s, just again 1 year of up more than 20% for the public equity index. And so even in this sort of unusual time, we still see private investments adding value over time. And so when we look at NSHE's managed private equity and venture portfolio, we tried to give the context of the extreme outperformance that we've seen, and not to let the recent years really obscure that. So when we look at the blue bars on the left of the screen, we see that the managed private equity and venture portfolios really added significant value versus its benchmark in 2020 and 2021. And so more than 24%, almost 25% outperformance versus the benchmark in 2020, and over 100%, almost over 108% rather in 2021 of outperformance. We try not to let that obscure the recent underperformance that you're seeing in 2023 and the 3 quarters that we've tabulated thus far for 2024. And so giving context again that, in a down year like 2022, where you see public markets in the gray bar in the middle, global public markets down, over 16%. The private investments for the managed private equity and venture capital, still held its relative value. So, again, in context, the outperformance that we've gained is from 2020 and 2021. That we're still near those valuations today, despite the underperformance in recent periods versus the benchmark. And then on slide 16 here, again, focusing on the longer term, I'd focus on the far right-hand side, looking at the striped blue and striped green bars showing private equity and venture capital, NSHE's managed private equity and venture capital, respectively. Those are both still, well ahead, outperforming the gray bar on the far right-hand side at 13%. So, which is the MSCI All Country World Index, which shows this modified public market equivalent of the benchmark for private equity and venture capital. And so, wanting to focus on the long term, we still believe that we still see that the outperformance is there from the managed private equity and venture capital allocation. This next slide is, we pulled together an analysis looking at the past 20 years of private equity and venture performance versus the public markets. And when we've seen these, the delta there, the column in red, where we've seen significant underperformance from private equity and venture compared to the public market index in one particular year, we've actually seen the following 3 years, on average, very strong performance from private equity and venture capital. And so, if you were to look at the 2023 and the first 3 quarters of 2024, those are some of the highest deltas or highest underperformance we've seen in over this 20-year period. On the right-hand side, we haven't yet seen what the following subsequent 3-year returns would be, but we can see for what we have tabulated thus far, on the right-hand side, on average, we're seeing 8.6, more than 8% annualized returns from annualized outperformance for private equity compared to its public market equivalent. And then again, here, just wanting to see the bigger picture. Despite on the left-hand side this 1 year underperformance of global private equity and venture capital returns, we really want to pay attention to the long-term 5, 10, and 15-year marks, knowing that we've seen this comparative outperformance of private equity and venture capital. So wanting to really key in on the idea that this short-term underperformance is not what we see or expect over the long term. We look at the risk-adjusted returns here. Again, this is performance through the most recent private investment results. So again, through Q3 of 2024, we see the trailing 5 years in the table on the towards the bottom. We see the total endowment has a 9.4% return versus the policy benchmark at 8.8%, and that's done with lower volatility or a smaller standard deviation at 13.7% versus 15.1%. And so that's how you'll get the stronger Sharpe ratio, which is the stronger risk-adjusted return at 0.52 versus the policy benchmark's 0.43. Similarly, over the 10-year period, trailing 10 years, despite the similar compound return at 7.1%, that for the total endowment is done with less volatility at 10.9% versus the benchmark at 11.9%. And that's how you get the stronger risk-adjusted returns. So as CFO Viton mentioned earlier, we look at this performance over different periods to understand the relative performance. And we do that over a 3, 5, and 10-year period using different benchmarks to help us understand performance. And we'll see in the subsequent slides, we look at the policy benchmark over the trailing rolling 3-year period. We look at the simple benchmark, or the stock, 70% stock, 30% bond benchmark over the trailing 5, and we look at the inflation, the distribution policy plus inflation over the longer 10-year period to understand performance and the cyclicality there. And so very quickly, I'll just go through some of the standard sections that we show here for compliance and governance. For asset allocation, we're well within our allowable range of allocation. In terms of liquidity, we are well within the guidelines here as well. And then in terms of the risk of the portfolio, again, we are seeing slightly less exposure to stocks, more exposure to stocks, but slightly less to more exposure to stocks and bonds than the benchmark, than our long-term target, excuse me. And I think I would show here, on slide 31, over the long term, we expect the portfolio to return 5.9% as an annualized return. But that, of course, comes with more volatility in the near term than it would in the longer term. And we're still comfortable with these expectations. I'm happy to pause there unless there are any questions.
Thank you, EJ. We appreciate it. Are there any regents or advisory members that have any questions? Regent McGrath?
I'm having a little trouble with this microphone. Thank you. Quick question. I understand for the endowment, obviously, we're looking at the long term, and that's what we want to focus on. I am curious, though, when I looked at this report. In terms of private equity and VC, in the immediate term, I mean, I think we're in kind of a strange environment. Continued inflation would be projected, tariffs, a little bit of instability. What do we expect in the immediate term in terms of how do those factors impact the private equity VC performance? I was just curious about that.
Yeah, it's a good question. And I'm pulling up slide 14 here to just show, again, a bit of the volatility that we observe over the short-term periods. It could, it could be very volatile in the near term, and that's to be expected. But I think over the longer term, we focus on the value that it can add over time. When we look at the shorter term, with volatile, when we're benchmarking our private equities to public markets over the short term, and the difference is really that private equity and venture capital are recorded or marked every quarter versus the public equities that are marked daily. And so we do tend to see a bit of a dislocation there. And so it's a bit harder to sort of ascertain what might the dislocation be, or how much that might dislocate in a certain year. But I think over the longer term, we're still focused on the fact that that private investments do add value compared to their public market equivalent.
Thank you.
And if I may, Wendy Walker for the record, we actually also believe that we're currently at an inflection point. EJ mentioned that we're still awaiting the December quarter results for private investments. Right now, only a small minority of managers have already reported, but those results are expected to be, or so far, coming in the slightly positive territory, up low single digits for the fourth quarter of 2024. Whereas global public equities were actually slightly down in the fourth quarter of 2024. So once these results come in, we would expect the performance differential for 2024 between public and private markets to narrow. In other words, private investments are coming in slightly higher, whereas public markets are coming down slightly. And as EJ pointed out, in prior periods of sell-offs, similar to the market volatility that we've seen recently in public markets, we've seen stronger outperformance in the private markets. And this is just because these managers have more tools for value add. They're still going to be buffeted by the same macroeconomic factors, but typically these managers can add value at their portfolio company levels, which is part of how and why they've outperformed in prior market sell-offs.
Thank you for that.
Are there any other questions by Regents or advisory members? I don't see any. EJ, you ready to move on?
I think we're good.
Thank you. We appreciate that. So then we'll move into agenda item number 7, the endowment pool performance. Is Wendy helping us out with that one, EJ, or are you going to present that as well?
That will be me.
That will be Wendy.
Okay. Thank you, Wendy.
Great. So I'm happy to, I can't share my screen. EJ, are you able to share this exhibit? Or if everybody has it, I'm happy to just speak to it. This is an exhibit that we prepare at the request of the Regents and a couple of the campuses on a periodic basis, comparing the NSHE endowment to the UNLV and UNR foundation pools, all of which are similar sized, but interestingly have different asset allocation approaches. This makes sense given that each of these institutions or each of these pools has a different spending rate and different approach to the strategic objectives. But what I think the key takeaway is when we look down at section C of Schedule 7 over reasonably long performance time periods, 3 years, 5 years, or our full OCIO track record, which is now 7.25 years. Most of all three of these pools, this is not the exhibit that we wanted to show. It was Exhibit 7, I think.
Chair Brooks, EJ, it's on the, if you're helping out with the presentation, it's on a different agenda item, number 7.
Chair Brooks,
So-
Chris Fatone. Unfortunately, we did not provide item 7 as a visual for presentation, so we weren't prepared
Apologies.
to
Okay.
project that one. I apologize.
So
Okay,
I'm
thank you.
happy to speak to it. Sorry, Wendy Walker for the record. But if we look over across, call it these longer term time periods, which is always our focus for these types of perpetual pools, all three of these pools of capital have posted respectable returns. So over the 7.25 years of our endowment track record, we can see that the pools all returned on a nominal basis, somewhere slightly above or slightly below 10%. And similarly, if we extend that out for the trailing 10-year period, similarly around that band. So from our point of view, it's helpful reference to make sure that there are no really extreme outliers between the performance of these pools, but I think each institution is pursuing its unique objectives, supporting its unique spending rate, and we're comfortable with the NSHE results and assume that the other institutions are also comfortable with those results.
Thank you, Wendy. Chair Bush, for the record, what I think we'll do is we're going to take just a quick 5-minute administrative break. And the reason for that is I really would like to get, for those who don't have public view of this specific item for Agenda 7, I think it's important that we're able to show where we are between the system, UNLV, and UNR. We'll take a 5-minute administrative break. Thank you. You would like to see in terms of any conversation you want to have about these comparisons, then you can please let us know and we'll slide down or up for you.
Certainly. And I cannot see that remotely. Here we go. Now I see it. So this is, I think, an excellent section to focus on here. Section C, which is the annual compound rate of return, or we can even see a couple of individual fiscal years up towards the very top of this screen. And I think what we'll see is between the three institutions, leadership in any given calendar or fiscal year might bounce around between one institution and another. That makes sense. They're pursuing different asset allocation, different strategy. But over the longer term here in Section C, you can see on a trailing 5-year basis, call it, returns are quite close, 8.3% for NSHE, 8.0% for UNLV, and 7.7% over the 5-year period. So for UNR. So I think each of these pools is supporting each institution's objectives over the longer term, 7.25 years. Again, NSHE is at 8.0%, UNLV is at 7.7, UNR is at 7.5 in 10 years. That gets pulled down by by including some more difficult performance close to a decade ago, but on a nominal basis, NSHE's return was 6.4, UNLV is 6.5, and UNR is 6.6. So again, very competitive with each other. I think each institution is executing well against its unique strategies and delivering comparable results.
Thank you, Wendy, for going over that again. Are there any regents or advisory members that have questions regarding this agenda item?
Yes, Chair Brooks.
Go ahead, Regent Goicoechea.
Thank you, sir. Regent Goicoechea for the record. I'm going to show you how green I am at this. What are the Russell investments and what's, I see it's with and without on this particular graph. If you, I don't, all my stocks got 4 feet in the mouth.
Thank you, Wendy Walker, for the record. We parsed out, there for a number of years, there had been 2 providers, Cambridge Associates and Russell Investments, each managing half of the NSHE portfolio. The dual mandate was terminated a couple of years ago and consolidated under Cambridge's leadership, and the Russell Investments portion of the NSHE endowment had underperformed quite significantly. So just for greater transparency for this group of regents, we've broken out under the far left column what the performance would have been with and without Russell Investments. So it had been stronger for the Cambridge part of the portfolio, but so it's just meant to be more of an indication of the current portfolio strategy, which Cambridge has maintained since we since we've been working together many years ago, is more represented by the green column, which is what the Cambridge portfolio would have achieved on a standalone basis. But the far left, the black column for NSHE, that combines both Cambridge and Russell Investments portfolios.
But we no longer have the Russell investment portfolio that's been divested.
That's correct. That's correct. And those assets flowed into the Cambridge portfolio a little over, I think it's going on 3 years ago. So it's a much, there's still a tiny amount of assets under Russell that are liquidating and are being distributed over into the Cambridge portfolio. So the results that you see over the past years has been Cambridge exclusively.
Well, thank you. I appreciate that. And I've got one more question. In this, I haven't been able to see, we don't see an allocation for what the actual fees are to Cambridge. Is that broken out somewhere, or is it a simple percentage?
I think it's 0.3% of the assets that we manage, a 30 basis point fee on assets.
All right. Thank you so much. Again, it shows you how green I am at this. So thank you.
Chair Bush, for the record, are there any other questions by advisory members or regents? I don't see any. Wendy, does that conclude your presentation?
It does.
Thank you very much.
You.
We appreciate it, and I think it was really important so that regents understand. The reason that I wanted to switch some of these agenda items was so that when we go into agenda item number 5, you can at least take a look at the sheets that you have in front of you regarding the endowment pool performances. So at this time, we'll move to agenda item number 5 and hear about the operating pool performance. Is this
great? Wendy Walker, for the record. I might start off with some market environment context to underpin both recent performance that you've heard about from EJ and that I'll speak to very briefly as part of the operating fund, but more importantly to underpin the rationale for our rebalancing recommendations in the operating fund, since this is a pool over which this committee has retained discretion with Cambridge as your advisors on rebalancing recommendations. If we could start on page 11, please, I would. Yes, thank you. So on the right-hand side of the page, we can see, and this is very much in the rearview mirror, on the right-hand side of the page, calendar year 2024 was another very strong year in the markets, and that's the performance that we are reviewing. EJ had mentioned US equities were up over 20% 2 years in a row. That's an extremely unusual sequential strong performance for any geography. Historically, it's been many, many decades since we've had 2 years in a row of 20% plus performance. And notably, the US over several years has been an outperformer. With the euro area, we can see in the right-hand side of the page, calendar year 2024 was up only 2.6%. So a real difference in performance. A lot of this has been led by bullishness around AI, as people have probably heard about, the Magnificent Seven tech stocks. All of these have been strong drivers of performance in calendar year 2023 and 2024. Fast forward to calendar year 2025, and performance has seen quite a bit of volatility and reversals of some of the trends that we've seen over the past couple of years. So the left-hand column, year to date, we can see that global equities are slightly up. Within that, US equities are actually down over concerns about there's uncertainty, quite a bit of uncertainty about what trade policy will be in the US. There's been a lot of announcements of tariffs and fast changing announcements to what the actual tariff implementation will be, along with some significant pullback in expectations for government spending, which is a very meaningful part of US gross domestic product. And therefore, some concerns that this will pull back on the growth of the U.S. economy. The euro area, in turn, has outperformed very strongly calendar year to date. On this page, which is through March 4th, which is when we finalized these materials, it was up 11.4%. As of yesterday's market close, I can share a verbal update. Global equities were up 0.7%. Within that, US equities are down now 3.2% through yesterday. These are the markets. Developed markets, excluding the US, are up 11.2%, and emerging markets are up 6.7%. And the reasons here are a couple of fold. So with increased concerns about growth, and that would be expected to be slowing growth globally based on how markets are currently interpreting trade policy and fiscal policy. US markets are more dominated by growth stocks. Those had benefited from all these tailwinds in the past couple of years, but if we're in a slower growth environment, what investors have been paying for those stocks seems less likely to pay off in the near term. So a lot of these growth stocks, AI-driven stocks, have seen very significant pullbacks in their valuations. The other real difference, and we've been talking for the past couple of years about the relative valuations difference between the US and other markets. At the beginning of the year, US equities, equities broadly are typically valued using price to earnings multiples. US equities coming into the beginning of the year were valued at 22.5 times this year's earnings expectations, which is fairly richly valued compared to history. Investors were willing to pay more for US equities on the assumption that growth was going to remain very strong. In comparison, for stocks outside the US at the beginning of the year, those were only trading at 13.3 times earnings. So much, much more conservatively valued. The expectations for stocks outside the US were not quite so high. And therefore, there was a little bit of a margin of safety on those valuations. So based on what we've seen in the recent market environment, lots of macroeconomic uncertainty, geopolitical uncertainty, investors have begun rethinking their very, very strong bullishness for US stocks and have instead been rewarding stocks outside the US in general that had been typically much more cheaply valued, and the expectations were not quite as demanding for those stocks. I share all of this as context for our revised rebalancing recommendations. We have a lot of other slides in here that provide additional context about recent market movements. I think a lot of these slides are 2 weeks in, somewhat stale because the markets have been moving so quickly. But I might just speak to the fact that we had some inflationary results in this section that spoke to the fact that January inflation had been higher than expected. Happily, since the time we published these materials, February inflation came in a little bit softer. So this is a continuation of not really clear signs that inflation is either going away or persisting at unusually high levels. So it's caused the Fed to not change interest rate policy. So any questions about the market environment? That's sort of a high level, and I'm happy to speak to any individual slides if there are specific questions. But again, given this fast-moving environment, a lot of the information that we put out 2.5 weeks ago seems to be fairly stale already.
Thank you, Wendy. Are there any regents or advisory members with questions regarding market shifts? I don't see any.
Okay, great. Then I might suggest that we go to our rebalancing recommendations, which are shown on page 8. Thank you. And we had previewed in our materials that depending on market activity, we might adjust our recommendations to account for recent market movements, which indeed we are doing. Our recommendations as of 2.5 weeks ago had been to trim from both US and developed ex-US markets, equity markets, because we were a little bit overweight to public equities at that point. We've done a little bit of a round trip from an overall equity allocation. But the difference today is that since US equities have pulled back and markets outside the US have surged, our new recommendations are to not trim anything from the Vanguard Institutional Index in the US. So instead of that 2.5% trim up top, we would rescind that proposed trim. Instead, we would recommend trimming 5 million from Vanguard Developed Markets Index. This is intended to harvest the recent very strong outperformance. So a $5 million trim from Vanguard Developed Markets Index, and then redeploying that 5 million down into Vanguard short-term inflation-protected securities with a $5 million add. It gets us to ending allocations very much in line with our policy targets. The end point is the same as what we see in this peach column here, but instead it would be a $5 million trim from Vanguard Developed Markets Index and a $5 million add to Vanguard short-term TIPS.
I'll take that pause as room for questions from regents or advisory members. Are there any? We don't have any questions right now for you, Wendy. Please continue.
Right, and this is our sole action item in this section, so would you like to take a vote on that? Or shall I talk about performance first?
Well, Chair Bush, for the record, I appreciate that, Wendy. So is there, in terms of the operating pool performance, I think there was a few more things I think that you may want to provide us with. And then when you're finished with that, then we'll open it up for more questions and go back to motions and voting. Thank you.
Perfect, thank you. Sorry, and I'm trying to find my place on in my materials. So as CFO Vitan mentioned earlier, the operating pool is, if we could go to page 26 of our materials, please. The operating fund is designed to support the cash needs of the campuses and the system. So it's a highly liquid pool. It's much more fixed income oriented than the operating fund. The operating fund is designed for long-term growth, whereas the endowment fund is designed for long-term growth and supporting a higher payout rate. Whereas the operating fund, there's much more emphasis from a policy perspective placed on, number one, liquidity, and number two, stability of the values. Which is why we see over the longer term that performance has been slightly lower, which makes sense just given that it has these different objectives in the overall financial structure for the system and the campuses. This pool is also designed as a very low-cost portfolio. The vast majority of the assets, all of the equities are implemented through index funds. So you'll see that there's very, very modest difference in performance between the US equity allocation or the global ex-US equity allocation and the underlying benchmarks, just because these are index funds. They're only designed to track those benchmarks rather than outperform them. So with that in mind, it's not really surprising to see over the trailing 5-year period that total operating fund performance is even with its benchmark. And since for the time period of the endowment OCIO relationship, there's just a 10 basis points difference in performance over this entire time period. This is how this pool is designed to work. So we have no concerns about performance. We think that this pool is operating as it's intended to support the liquidity needs of the campuses. And according to policy, we're inclined to simply maintain allocations roughly in line with policy. And that relates to the rebalancing recommendations that I just spoke to.
Chair Bush,
Go ahead.
Chair Bush, for the record, it seemed like there was a pause there, so I thought maybe you were waiting to see if there were any questions from Regents or advisory members, so I'll ask if there are. No questions yet. Please continue.
Great.
The
final, yeah.
I'm sorry, Wendy, I'm just trying to understand this whole, all right, the total operating fund then is at 843, is that correct, million?
Yes, that's correct, sir.
And I'm just trying to get my head wrapped around all this. And liquidity pool is roughly a third of that.
That's
at 250 million. Okay. Explain to me, and I apologize to the other regions. You guys probably understand this, but I'm just, all right, why that breakdown? And then technically, the liquidity pool, is that the one we would pull like the 2.75% from? That goes to actual operating to these institutions, is that correct? Or am I confused?
Yeah. These are more notional allocations of an overall pool, and I might welcome input from CFO Viton on those accounting mechanics on those distributions.
All right, thank you. I won't push it any farther. I think it's about, Chris and I will have to have an afternoon together so I can figure this out. Thank you.
I don't mind answering if it's okay, and I'm more than happy to spend more time also, but just to, I can, quick high-level answer to your question, Regent, then Chris Fatone for the record. The 840 million represents the entirety of the operating pool, and it's on that value that we calculate the 2.75% as an annual amount, and then distribute 1/12 of that annual amount monthly, proportional to each institution's share of that 840 million. The 250 million represents the short-term component of that that total fund. That's the portion that the daily deposits and disbursements flow through that allow the campuses to maintain their daily operation. So it's just that is a portion of it, but the actual earning distribution is based on the entirety of the pool.
All right. Thank you so much, Mr. Raton. Thank you, Mr. Chair.
All right, Chair Bush, for the record, if you'd like to continue, Wendy, please go ahead.
Certainly. I might just speak to one additional slide on page 29 of these materials that I think is a helpful point of reference as we think through the difference between the endowment and the operating fund and the goals that it's attempting to support for the system and the campuses. So on this page, we can see a similar graphic, but the expected return for the operating pool over the long term is only 3.8% real. So that's lower than what we saw for the endowment. I would also point out that for both of these institutions, these are real return expectations, so net of expected inflation. The actual nominal results will be higher than these real return assumptions. And similar takeaway to what EJ had mentioned about the endowment is that over short-term time periods, the range of expected returns around this, around the median expected return of 3.8% real, it's much wider in short-term periods, but over longer-term periods, there's a compounding effect, and what might be a very strong or a very weak individual calendar year basis over the long term is more likely to compound to a narrower band around this 3.8% expected return. So this 3.8% expected return over the long term, we would expect to comfortably support that 2.75% annual real distribution and keep up with inflation over time. And that would be the final prepared remark that I have planned, but happy to address any questions.
Thank you, Wendy. It's Chair Bush for the record. So it sounds like your presentation is concluding, and I'll ask if there are any regents that have questions about any slide or anything that was brought up regarding agenda item number 5. I don't think there are any questions by the regents. I have a couple of questions, though, that I'd like to ask Wendy. So if we take a look at the operating fund versus asset allocations for the endowment, and we look at the percentages regarding equity, certainly in the endowment, the equity percentages are lower than in the operating fund, and I was hoping that you can address that and explain to us the reasons why that would be.
Certainly, and for the record, I think it depends on whether we're looking at the total long-term pool or the total operating fund. If we're talking about the total operating fund, I think the total operating fund is allocated much more towards fixed income than what we see in the endowment. And those are excluded from these asset allocation percentages that are shown on the screen here. And part of this is because, the primary purpose for this operating fund is to support cash needs for the campuses. So there's always, I think it's a minimum threshold of some that system staff monitors of somewhere over $150 million in cash just to support the ins and outs of this portfolio. And then we also have short-term fixed income or I should say intermediate term bonds, which are sort of a backstop for the liquidity needs of the institution. But that said, your observation is correct that in the total long-term pool, we have a 67% policy target to public equities. I'd characterize the difference between this and the endowment asset allocation is the endowment asset allocation has many more alternative assets. The private equity and venture capital that we've shown that NSHE's lived experience as well as our broad universe of private equity and venture capital has added significant value over the long term over public markets. So that's part of the reason why the endowment target to public and private equities comes in a little bit short of what we see here in total equities for the operating fund. The other point that I would make is that we have a sizable allocation to real assets in the endowment as part of a diversified portfolio. That includes private real estate, private infrastructure, private natural resource investments. And those tend to have, while they have, they're separated out as real assets because they're intended in the portfolio to provide some inflation sensitivity for the endowment. They also carry a reasonably high amount of equity risk in those. So often the public and private equities plus real assets might together be considered risk assets, whereas the marketable alternatives, or also known as hedge funds, those also are alternative assets that support the growth of the portfolio. So overall, this operating fund, we have a high allocation to TIPS, which are a form of inflation sensitive or inflation linked bonds. We have a relatively higher allocation to long-term bonds, fixed income, and both of those together are higher than what we see in the endowment, which is more diversified across alternative asset classes. But many of those alternative asset classes tend to have an equity risk component. Does that address your question, Regent Brooks?
Thank you. I appreciate that. It does. It certainly begins a process of maybe some more conversation about some of the percentages and breakdowns, right?
Okay.
Regarding the operating fund and endowment fund. In the operating fund, if we look at bonds are about 2%. And I'm just wondering if there might be a more advantageous way of increasing funds if we take a look at something other than bonds. And I'm wondering if there might be thoughts or recommendations from Cambridge regarding that. And I would also invite our CFO, Chris Fatone, if there's anything you'd like to add to the discussion of what we're doing with 2% regarding bonds.
So I think in the operating fund that we're significantly higher than 2% in bonds. And just to put some specific numbers on that. Sorry, I'm going to my back to the rebalancing schedule. So we have 13% in long-term bonds and another 20% in inflation-linked bonds. So it's about a third of the operating fund is in fixed, of the long-term pool in the operating fund is in fixed income. And then when we add in the liquidity pools, those are all either intermediate term bonds or short-term bonds and cash. So I think it's probably close to about 60% of the overall operating fund is in fixed income and cash.
Chair Brooks, for the record, thank you, Wendy. So if we take a look at the 2025 column, and if we go down, it seems to me like intermediate term bonds, it shows 2%, which is what I was referring to. And so the report.
I see.
Yeah.
Sorry.
That's
Now I'm
okay.
following. Thank you for that.
Sure.
So that's an estimated return for the month of February. The top of the column, it's probably not spelled out very well, but the top of that column indicates that's the estimated return for February 1st through March 4th. But we don't have, since our asset allocation policy for the operating fund, it's really split into two segments. We think about our asset allocation policy as governing the long-term pool. So you can see this 2/3 of the way down the page, the long-term pool, these allocations add up to 100%. This is what Cambridge comes to the committee to rebalance, is within the long-term pool. So all these allocations add up to 100%. So in the green column, as of December 31st, sorry, if we can go back to the slide we were just on. If we could go back to the rebalancing schedule, please. The green column, as of December 31st, we had a little under 13% in long-term bonds and, sorry, my eyes are bad, a little over 19% in inflation-linked bonds. And then down below, the two liquidity pools, the intermediate term bonds and the short-term bonds and cash, those are not governed by an asset allocation policy, but rather system staff monitors these with an eye towards the liquidity needs of the underlying account holders within these pools. So these balances, NSHE staff, the finance team might come from time to time with a recommendation to either add to the intermediate term and short-term pools or distribute dollars from these two pools into the long-term pool. So the operating fund as a whole is segmented into the long-term pool and then these two liquidity pools. Does that help? Does that help explain some of the questions?
Thank you, Wendy. Regent Bush, for the record, I appreciate your explanation. I would ask our CFO, the way that I was looking at this was, it seems like it's a extraordinarily conservative measure. And so my thought process was, is there something that we can do where if we're going to take a percentage specifically for allocation of investment, could there be something else that we would take a look at in terms of a way to invest other than the bonds?
Chair Brooks, thanks. Chris Vitone for the record. I think I suppose there's always an opportunity to look at alternatives, and I know that there have been periods of time where the committee has considered more aggressive or more risk-taking in the operating pool Again, balancing that with concerns that this is the campus's operating cash, but because there is a significant portion that is not needed on a daily basis, that's where we have the long-term portion that is taking a somewhat more aggressive stance for operating funds. So that's the distinction really between the short-term component and the long-term component. And I would say on the short-term component, I would not be in favor of more risk-taking, because that does represent the more of the daily churn, if you will, for the campuses being able to manage their disbursements. However, on the long-term portion, I think there has been periods of time where the committee has considered whether or not it might be reasonable to take an approach more similar to the endowment pool and open it to alternative investments. I think the approach that's being taken, I think, looked at in the past at the difference in performance between managed funds, compared to index driven funds, and having concluded that there often was not a significant enough difference between the managed approach around indexes and the indexed funds. That's why we are, that's where we are today. That led to a decision to focus on indexed funds as the primary driver for the more risk tolerant component, the long-term component of the pool. I think that's something that your question of should we consider something more aggressive, I think is a question this committee has considered in the past, and we could certainly bring some information for a future committee meeting for you to consider in that regard.
Chair Brooks, for the record, thank you. I appreciate that. I think one of the things that it would be interesting to see, considering the largest financial institutions in the world are currently looking at various ways of cryptocurrency in investment portfolios. And I think it makes sense to just take a look at that. And perhaps there's some things that you can bring back to the board in conjunction with Cambridge to showcase what that would look like if we started taking a look at cryptocurrency as, as a marketplace for us to be in, to enhance some of the things that we're doing with long-term operating funding.
Certainly, we have information we'd be happy to bring back to this committee.
Thank you, Wendy. So I'll just to make sure, based on conversations that we've had, I just want to make sure before we vote on the recommendations for rebalancing, if there are any other questions from Regents or advisory members, then please ask those questions now. I don't see or hear of any questions, so what I'll do is ask for a motion to approve the rebalancing recommendations.
I'll make a motion to approve the rebalancing recommendations.
Regent Fernandez, second.
Thank you. I'm just hearing a little bit of, I appreciate that. So we have a motion on the floor to approve the recommendations. The motion was presented by Regent McGrath, seconded by Regent Fernandez. Is there any discussion?
Chair, just if I could ask for a clarification, there's the recommendation that was in the report, your advisors have recommended a revised rebalancing, and I just want to make sure that the motion and the second are referencing the revised rebalancing recommendation as it was communicated by Wendy Walker from Cambridge when she presented.
Thank you. Chair Bush, for the record, I appreciate that. I think it's been made clear, right, that we're taking a look at what are the updated and new recommendations, and that's what we're voting on as we move forward. I will ask, as part of discussion, though, were there any recommendations? Because if we take a look at slide number 8, in terms of operating fund, it seems like there is some space for an opportunity for the system office to weigh in, and I didn't know if there was anything that you wanted to weigh in on regarding this.
Thank you, Chair. And Chris Fatone, for the system office component, I would not make a recommendation at this time. This, given the volatility and the timing of disbursements the campuses have, particularly around the start of the semesters and looking ahead, I was okay with this balance that we have today.
Chair Brooks, for the record, thank you very much. So at this time, with the motion on the floor presented by Regent McGrath, seconded by Regent Fernandez, I'll just ask for a quick vote. All those in favor of approval, please signify by saying aye or yay.
Aye.
Anyone who opposes, please signify by saying no or nay. I'm going to ask real quick, did we have enough? It didn't, okay, thank you. So the motion passes? We will now.
Yeah, Regent Brooks, this is Regent Brooks, this is your counsel. I believe that we have Regent Fernandez on, and so we still do have a quorum, if that was your question. And I believe if I heard the votes correctly, the motion passed.
Thank you. Chair Bush, for the record, please appreciate the clarification by you. We'll move on to agenda item number 8, which is new business. Are there any suggested items of new business for consideration for a future meeting? Hearing none, we'll move on to agenda item number 9.
If I may,
Oh, yeah,
may I?
sure.
I apologize. I couldn't click my audio button fast enough.
It's okay.
For the record, this is Randy Garcia, the chairman of the investment committee for UNLV. It would be helpful from my personal perspective if we received the report that I believe that the NSHE board has access to by Callan prior to this meeting. If we could also receive the Cambridge report as well by email prior to the meeting, would be greatly appreciated.
Thank you. We'll move on.
Is that possible, or is that a request that could be honored? May I ask?
So
By Cambridge.
it sounds like, Randy, what you're asking for is just the reports, that you would have those. And if that's a new business item that you're thinking we could bring forward to ensure that you're getting reports, I would say that we may be able to just get that done without creating an agenda item for that. Our CFO is signaling me, so I'll allow him some time to weigh in on this.
Yeah, Chair Brooks, yeah, this is Chris Nielsen. I'm with you. I don't believe this is a new business item per se. I think it's just, I think it's a request that can be taken to staff and treated as such. And I'll let CFO Batone weigh in additionally if he'd like.
Nothing to add. I was just.
Thank you,
gonna
because
offer-
it would be helpful to me, and it'd be helpful to me and perhaps others. It's easier to study it on a piece of paper ahead of time as opposed to try to read all that data in very small font size on a computer screen. That's one reason I'm not able to ask questions, because I can't study it given the font size in quick time. So thank you.
Chair Bush, for the record, thank you, Randy. We'll make sure that information is provided to you. We'll now move on to agenda item number 9, which is public comment. Is there any public comment at GBC?
There is none at this time.
Thank you. Is there any public comment at the system office in Reno?
None at this time.
Thank you. Is there any, I don't see any public comment here in Las Vegas. Is there any public comment on the phone?
There's no public comment at this time.
Thank you. And with that, we will adjourn the meeting. Thank you very much.